Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our video on IFRS 1, first time adoption of IFRS 104. Hope you will like, share and special request to all too. Don't forget to subscribe our channel. IFRS 1, first time adoption of International Financial Reporting Standard 104. The project on the first time adoption of IFRS 1 was added to ISB's agenda in September 2001. IFRS 1 was issued in June 2003 and a restructured version was issued on November 24, 2008. IFRS 1 specifies the procedures to adopt IFRS. It must be clearly written compliance with IFRS for the year ending, say, 31/12/2023 as the date of transition to IFRS. The entity presents an opening statement of financial position that is prepared at 1/1/2023. That opening statement of financial position is the entity's first IFRS financial statement. It is to be noted that at least three financial statements of financial position are presented. Herein, the entity has the option to report selected financial data for the periods prior to 1/1/2023 as long as they do not purport to be full financial statement. The opening IFRS statement of financial position will still be 1/1/2023. Note: the opening statement financial position, the financial statements for 2023 financial year and the comparative information for 2022 are prepared as if the entity had always used the IFRS accounting policies it has selected. Objectives: the objective of IFRS 1 is to ensure that an entity's first IFRS financial statements and its first IFRS interim financial statements contain high-quality financial information that A is transparent for users and of course comparable overall periods presented. B provides a suitable starting point for the entity's accounting under IFRS. And third but not the least, can be generated at a cost that does not exceed the benefits to users. As the name suggests, IFRS 1 to be applied for all entities in its first IFRS financial statements, and therefore it means IFRS 1 does not apply to entities that already apply IFRS, and an entity may be a first-time adopter if, in the preceding year, it prepared IFRS financial statements for internal management use, as long as those IFRS financial statements were not and given to owners or external parties such as investors or creditors. Here to note, an entity can also be a first-time adopter if, in the preceding year, its published financial statements asserted compliance with some but not all IFRSs, including a reconciliation of selected figures from previous GAAP to IFRS, and previous GAAP means the GAAP that an entity followed immediately before adopting to IFRS. Accounting treatment: opening statement of financial position, that is balance sheet. The opening IFRS statement of financial position should recognize all assets and liabilities whose recognition is required by IFRS, but not recognize items such as assets or liabilities whose recognition is not allowed by IFRS. An entity should use the same accounting policies in the opening statement of financial position and throughout all periods presented in its first IFRS financial statements. Those accounting policies should comply with each IFRS that is effective at the end of its first IFRS reporting period, subject to certain exemptions as explained in our next slide on recognize, remove, reclassify, and apply. An entity may early adopt an IFRS that is not yet mandatory on transition to IFRS, provided that IFRS allows for early adoption. Recognize all assets and liabilities as required by IFRS. Example of changes for byproducts, leases, pension liabilities, assets, and deferred tax on revalued assets. Remove assets and liabilities whose recognition is not allowed by IFRS. Examples of changes for deferred evading gains and losses, other deferred costs, etc. Reclassify items that should be classified differently under IFRS. Examples of changes for financial assets, liabilities, financial instruments, etc. As adjustments required are reclassifications between statement of financial position item. Apply IFRS in measuring assets and liabilities recognized. Any adjustments resulting from events or transactions that occurred before the date of transition are recorded directly in retained earnings unless another category of equity. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share, and subscribe to our channel Accounts and Finance with FARSK. Thank you. Have a great day.